Oil edging higher to start the month of February as the market digests the Fed's path for inflation, or interest rates rather, and the latest OPEC meeting. Now, this coming after oil prices close out January with its first monthly gain since September. Here to dive into the energy trade, we've got Sam Dart, who is the Goldman Sachs head of global natural gas research. Sam, great to have you here with us this morning. First and foremost, as we come off of the month of January and kind of look back to what fluctuations we saw in the oil price market, what does that set up? What's the trend looking like going into February?
Yeah, so the geopolitical tensions, especially in the Red Sea region, have definitely played a role and have lent support to oil prices a few dollars a barrel in recent weeks, right? But the way we look at the market, we still see oil prices range bound between $70 and $90 a barrel. A big reason for that is at the end of the day, despite the tensions, we have not had serious supply disruptions. And in fact, we still have a lot of supply spare capacity in the system.
So Sam, what does that mean then for prices going forward? Because here we are with Brent right around $82. We have crude that has been moving to the upside. Are we near that top that we would potentially see, at least in the short term, given the fact that this disruption hasn't had a massive impact on the crude market?
Yeah, we think we are. We expect to see oil prices peaking this year in the low to mid 80s. So we're pretty close to those levels already. We don't see a lot of fluctuations unless we had a pretty significant supply disruption in the system.
What would a significant supply disruption look like? Is that an OPEC decision? Is that more international uncertainty or conflict there that stems? What is perhaps that biggest headwind risk that then spurs the perhaps exogenous threat?
Right. So OPEC has been cutting supply now for many, many months. So the way that has played out, because inventories are not particularly tight, it's actually, it provided a cushion to the market, meaning if things go tight, you can have that cushion used with OPEC bringing back supply. Now, the big risk, to your point, is if there is some exogenous factor that can block it. So, for example, if we had a blockage of the Strait of Hormuz, which would indeed block a lot of Saudi supply of oil, that would be extremely problematic for the markets because it would impede OPEC from bringing back barrels to the market. Now, to be very clear, we think this is very, very low probability. This has never happened, and there is a reason for it. It would block, by the way, not just oil supplies, but a large share of LNG, liquefied natural gas supplies to the world as well.
Sam, another trade that got our attention is the price of lithium, the fact that it has been under tremendous pressure now for quite some time. A bit of good news here for some of those EV players that are struggling with demand. When it comes to that depressed price of lithium, do you expect it to stay at these levels, or what does the trend look like, do you think, for 2024?
Yeah, this is something we have been calling for a few months as well. It's interesting because we talk so much about green demand, and this is a strong pillar of our bullish commodity views, but especially on the copper side. When it comes to lithium, the issue is that supply is very abundant. So even though demand is there and it's still growing, you don't have tightness in the market. So we expect this softness to continue on the lithium side. Whereas on the copper side, what we see is the opposite. We see demand still growing, but the supply picture is actually getting tighter year after year.
You know, as we're thinking across some of the commodities, what is the hottest area that investors perhaps should be positioning their portfolio or adding some type of positioning in their portfolio where you're seeing a lot of volume or inflows?
Right. So I would say two things. From our side, where we see most upside is really copper and refined oil products. And the reason is on the copper side, as I said, supply is dwindling, so you have a tighter and tighter market. And on the refining side, you know, I just mentioned the spare capacity from OPEC for oil that does not exist among oil products. So the product market is very tight as well. So when we recommend the best opportunities, we really focus on those two, copper and oil products. Now, when we talk to investors, where we see the most interest has been on the copper side. I think that's the most consensus view at the moment, whereas on the refining side, we still get some pushback with investors expecting high product prices to fix the problem by inviting more refining capacity. We don't think that's likely just because refining capacity takes really a long time to build. And especially these days when you have so much uncertainty regarding long-term oil demand, it's difficult to also get capital availability for that kind of investment.
Sam, let's talk about gold real quick before we let you go, because it is under a bit of pressure this morning, but not maybe as much as investors would have anticipated, given the fact that Fed Chair Jay Powell basically said that the Fed is not going to cut rates in March. When the Fed, or if the Fed eventually does decide, when it does decide to cut rates, how big of a catalyst do you think that's going to be for gold prices?
Yeah, it's definitely a powerful catalyst. And by the way, that's another commodity where we see a lot of investor confidence. It's one of the preferred commodities. We think that support is still there. And yes, as you pointed out, in large part because of declining rates going forward, but also supported by geopolitical risks. So there are a lot of good reasons to go into gold right now. We still expect it to go above 2,100 by year end.
All right, Sam Dart, always great to have you of Goldman Sachs. Thanks so much for taking the time to join us here this morning.